Welcome to the Platinum Freight Podcast with Peter McRae, a podcast for business owners sharing the latest news and tips about customs clearance and freight forwarding. Welcome to episode 8 of the Platinum Freight Podcast with Peter McRae, Customs Broker. Today's episode is on the topic of the value of customs and how goods are taxed when imported into Australia. So, Peter, how does the Australian Border Force or ABF assess the value of imported goods for the purpose of calculating import duty and GST?
So this is a big topic, and it's a complex one. It's a detailed topic, and it may take some time to break this down. Maybe even settle in for a bit of a long discussion. But what I'll do is I'll divide it into sections. So generally, there's a rule that if the goods are under 1,000 Australian dollars, so if the goods, just the goods, not the shipping, but if the goods are under 1,000 Australian dollars, then generally those goods will not be required to pay any import duty and won't be required to pay any import GST. So that's the best scenario. But then there are other scenarios where if the goods are over 1,000 Australian dollars, then the goods will be assessed to see if the goods need to pay the import duty, and they'll be assessed to see if the goods need to pay the import GST. So some people might think, oh, but everything has GST on it. And in the customs world and the Australian Taxation Office, there are some items that don't need to pay import GST. The exemptions are surrounding medical devices and food. Australia then has free trade agreements with various different countries. So if the goods are subject to import duty, there's a possibility that the free trade certificate will be able to wipe out any import duty that would be payable, but the import GST in more cases than not would still be payable. Then to add extra layer, extra detail, if an importer wishes to bring in wine, then there is a tax called the wine equalization tax. So the importer would be needing to pay 5% import duty, 29% wine equalization tax, and 10% GST. If an importer wishes to import a luxury car, which is defined with the Australian Taxation Office, then there is a luxury car tax. But in the general terms, when a person or a business imports to the country, it would be what is the purchase price, convert that to Australian dollars, assess if the goods are liable to import duty. If they are liable to import duty, is there a free trade agreement, a free trade certificate, which can bring the import duty to zero? Then what were the shipping costs to bring those goods to Australia? Combine those three figures and then times it by 10% to receive your GST. And that will be the GST amount that the importer or business needs to pay. So some people would have realized that I said you add the shipping cost to the price of the goods. So yes, the GST is calculated on the goods and the shipping costs to bring the goods to the country. And then to make it even more complex, there are issues or charges that need to be added as additions, such as if there is any special artwork created for these goods, if there was any special tools created to produce these goods, if the importer is actually going to pay the overseas supplier to send their representatives to Australia to install the machines at the Australian importer's premise, then the airfares from overseas to Australia need to be added into the price of the goods. The tooling cost needs to be added in, the artwork, and there is a large list of additions that are taxable. Just because these fees are not mentioned on the commercial invoice doesn't mean that GST is not payable, and a customs broker would need to know what the total contract price was or is, so that it can be assessed of what additions need to be added to the base price to work out the Australian 10% GST.
What are the potential consequences for importers who attempt to devalue their commercial invoices in order to reduce their tax liability?
So this topic, this scenario happens more than anyone would expect. And it generally is where the overseas supplier offers the Australian importer two sets of paperwork. One is devalued and one is the correct paperwork. And in my mind, I find it bizarre that this happens because I don't see the benefit of submitting fake documents to the ABF if your livelihood and your longevity of running a business is to go for a long period of time. Why would you want complexities with your import transactions that are submitted to the ABF? But if I just give a scenario, so many times in a week, customs brokers all around Australia would be given paperwork on face value. It looks correct. Then, when the importer is asked to provide the bank receipts, the bank transfer receipts, proof of payment for the goods, it's not uncommon to see that the importer paid double or triple the amount than what the original paperwork states. And then at times when we ask the importer, how did this happen? The common answer is the overseas supplier said that this was usual practice. The overseas supplier offered us two sets of paperwork, and to us, it's crazy that that happens. And I can only assume that the overseas supplier thinks it's a way of keeping the importer close, or trying to, I guess in some way it's a form of manipulation to try and keep that importer close to them and to feel like that the overseas supplier is on their side and the overseas supplier has their best interest at heart. But in effect, it just causes problems for the Australian importer if ever they are audited, and if their compliance record is affected, then it's going to cause problems for future shipments.
And how long does the paperwork submitted to the ABF remain open for audit? And what types of penalties or issues can arise during this period?
So the Customs Act 1901 states that the importer needs to retain their documentation for a minimum period of 5 years. So if an importer through their customs broker submits the declaration, for example, today, then the importer needs to retain that documentation in the event that they are audited for the next 5 years. And then if there are irregularities found, then the ABF can issue a penalty. And if so, there could be a penalty in relation to the import duty being evaded. So that word evasion is where you're deliberately trying to not pay a tax. But in the Customs Act, the word is smuggling, where you are attempting to defraud the Commonwealth from the duty that they're entitled to collect. So we don't think of playing with the government in relation to figures as smuggling. We think of that as someone who's bringing something to the country that they shouldn't have, but it is actually in relation to defrauding the Commonwealth.
Can you explain what production assist costs are and why are expenses like airfares for overseas suppliers coming to Australia to install and commission equipment considered taxable?
So we have seen it many times where Australian importers will establish a production line, or, for example, they might be importing 6, 8, 10 shipping containers of cargo, and then they will then have a contract where the overseas supplier will send their representatives, their technicians to Australia to install and commission the equipment. And some might say, regrettably, some might say, understandably, that those fees need to be included into the customs value. So the Customs Act states that the price paid or the price payable for the goods is the price that you need to pay tax upon. So not only are you paying for the goods, you are liable to pay for the production assist cost. You are liable to pay the cost to bring the goods to the country, for example, by air or sea. And then when you combine those charges and those fees, the end result is that is the amount, the price that you will pay GST on.
How can a customs broker help importers navigate the complexities of customs valuation and ensure compliance with Australian regulations?
It's always it's always difficult because a customs broker is not there to see behind the scenes what is being agreed upon to buy the goods. So the customs broker will receive a document, and that will be the commercial invoice. Customs broker may receive the detailed contract showing who is responsible for this fee and who is responsible for that fee and when the payment is due. So, as a customs broker, we really only know what the importer tells or provides us. But in our instance, we would ask the importer to provide the invoice as the bare minimum, and then we would ask about production assist cost. We would ask, are there any representatives from overseas coming to the country to install this machinery or this production line? And we have a checklist of questions that we would ask, and then we would advise the importer that these scenarios, these issues are taxable in the eyes of the legislation of the Customs Act 1901.
And finally, can you share some best practices for ensuring that the value declared to customs is accurate and compliant, and how importers can avoid some of the common pitfalls?
So the first comment that I would say is that when an overseas supplier offers two sets of paperwork, that the Australian importer declines that invitation and has all of the paperwork prepared correctly, and to make sure that that paperwork can be verified through proof of payment, and to also be aware that all of this paperwork needs to be retained by them for that period of 5 years.
Thanks for sharing your insights and tips, Peter. Now, to learn more about customs clearance and freight management services, visit platinumfreight.com.au.